Welcome back to our channel. We are discussing on accounting for amalgamations and mergers. AS 14 versus Ind AS 103. Friends, merger and acquisitions are one of the most powerful corporate strategies. We have traveled a long way from traditional accounting standard 14, accounting for amalgamations, to the modern IFRS aligned Ind AS 103 business combinations. Now I will discuss the key differences, the practical challenges, and some of fascinating case studies. We'll see why these merger and amalgamations and acquisitions are happening. The reasons, such as achieving economies of scale, gaining synergies, assessing new markets and technology, eliminating competition, strategic restructuring under regulatory or economic pressure. So, but the legal way merger is structured often differs from the accounting way it must be presented. That is why we need accounting standards to ensure faithful representation and comparability of financial statements. We'll see India's accounting standard 14, AS 14. We'll see overview of the AS 14 first. Let's start with AS 14, which is still applicable for entities following old Indian GAAP. So there are two methods involved in AS 14. One is the merger pooling of interest method, and another one is the purchase method. I'll first discuss on amalgamation in the nature of merger pooling of interest method. This method applies when all assets and liabilities of the transferor are taken. These are taken over by the transferee company. So all the assets and liabilities of the transferor are taken over by the transferee company, and shareholders holding at least 90% of face value of equity shares. 90% of shareholders will continue. So the shareholders holding at least 90% face value of the equities in the transferor company become the shareholders of the transferee company. The consideration is only equity shares, except for fractional entitlement, and the business of the transferors is intended to continue, and no adjustments are made to the book values, except to ensure uniformity of accounting policies, carry forward assets, liabilities, and reserves. And accounting treatment, assets and liabilities are recorded at the existing carrying amounts. Reserves of the transferor are carried forward to the transferee's book, except revaluation reserves in the certain cases. No goodwill arises. It is as if the two companies have been part of the same group from the start. So we'll see the purchase method also. Amalgamation in the nature of the purchase method. This applies when one or more of the above conditions for a merger are not satisfied, which we have discussed now. We'll see the accounting treatment. Assets and liabilities are recorded at the fair value as on the date of the amalgamation. So the difference between the purchase consideration and the net assets acquired is recognized as goodwill if consideration is above net assets. If consideration is less than net assets, then capital reserve. Goodwill is amortized over its useful life, generally not exceeding 5 years unless a longer period can be justified. We'll see AS 14 core principles. Economic substance over legal form, and conservatism, fair value adjustments, and goodwill recognition in purchase method. And reliability, adequate evidence for merger classification. This dual approach gave preparers flexibility, but also allowed more transactions to be classified as mergers, carrying forward book values and avoiding good value. So this dual approach which we have discussed now, this gave flexibility, but also allowed more transactions to be classified as mergers. So the carrying forward book values and avoiding goodwill. Now we'll see AS 103. 103. This is the acquisition method. So with the adoption of AS, India aligned with the IFRS 3 and the entire game is changed. Ind AS 103 says there is only one method for business combinations. That is one acquisition method. The acquisition method for all business combinations. The acquisition method. Exceptions exist for common control transactions which are dealt with separately. The key steps in acquisition method. First, identify the acquirer. So the entity that obtains control, and determine the acquisition date, the date of the control passes, and recognize and measure all identified assets acquired and liabilities assumed at fair value. Any non-controlling interest, that is NCI. NCI is non-controlling assets, non-controlling interest. So any non-controlling interest at fair value or at the proportionate share of the net assets. Calculate goodwill. Goodwill is equal to consideration transfer plus NCI. NCI is non-controlling interest plus fair value of the previously held interest minus net assets acquired. This is the way to calculate goodwill. Then post-acquisition measurement. So subsequent measurement is goodwill is not amortized. It is tested annually for impairment. Contingent consideration is remeasured at fair value through P&L if classified as a liability. Now we'll see the major conceptual shift versus AS 14. So AS 14 versus Ind AS 103. No more pooling of interest for unrelated parties. Fair value measurement for everything, including intangible like brands, patents, customer relationships. Goodwill is impairment tested, not amortized. Goodwill is impairment tested, not amortized. More guidance on contingent consideration, restructuring cost, and step acquisitions. This is what the differences. Once again, I'll explain the differences. I'll summarize. AS 14, two methods, merger and purchase method. AS 14 merger, that is a pooling interest. AS 14 purchase, that is a purchase method. Ind AS 103 acquisition method only. And assets and liabilities values. AS 14 merger, that is a book values. AS 14 purchase, fair values. Ind AS 103 also assets and liabilities at fair values. We'll talk about the reserves. AS 14 mergers carry forward. AS 14 purchase not carry forward except statutory. Ind AS 103 not carry forward. These reserves will not carry forward. And goodwill, AS 14 merger. So no goodwill. AS 14 purchase, recognized and amortized. Ind AS 103 recognized and impairment tested. And about intangibles, AS 14 merger not separately recognized and purchase, okay, limited. Ind AS 103 intangibles mandatory fair value recognition if identifiable. NCI we have discussed, not detailed in AS 14 merger, not detailed even in purchase method, but detailed measurement options in Ind AS 103. And about contingent consideration, not detailed in AS 14 merger. In purchase, AS 14, it is a limited. Ind AS 103, mandatory fair value recognition and remeasurement. So this SWIFT is towards transparency, but more complexity. Yes. We'll see the case studies. Case study 1. Let's see how this plays out in practice. HDFC Limited, HDFC Bank in 2023. So this is a massive composite scheme. involving regulatory clearance from RBI, SEBI, NCLT. Consideration of the equity shares issued by HDFC Bank and treatment of statutory reserve was a key accounting decision. Complex valuation mechanics, if you see, to align scheme terms with Ind AS requirements. We'll see another case, Tata Steel, Bhushan Steel. This is acquisition under Insolvency and Bankruptcy Code. Determining fair value of assets intangible like mining rights and onerous contracts. Measuring consideration including assumed liabilities. Extensive valuation expert involvement is there in this scheme. And there is another scheme, ONGC, HPCL, government to government stake sale. Accounting for employee obligation and downstream regulatory assets. Here the complexity is due to being a regulated public sector entity. And the complex areas and professional judgment. Some of the most challenging areas in Ind AS 103 include goodwill measurement and impairment testing, requiring reliable forecast, CGU allocation and sensitivity analysis, and bargain purchases, rare but must be reassessed to ensure no errors, and contingent consideration, estimating probabilities and updating fair values. Restructuring costs cannot be recognized at acquisition unless pre-existing obligation exists. Now the practical guidance is, first identify the acquirer and acquisition date. Engage valuation experts for fair value measurement. Document assumptions for goodwill and intangibles. Monitor contingent consideration terms post-acquisition. And ensure disclosures are clear, especially for goodwill impairment assumptions. Now the conclusion journey from AS 14 to Ind AS 103 is a shift from flexible dual path approach to a single fair value based globally aligned standard. It involves more work in measurement and disclosures, but greater reliance on valuation specialists, higher judgment and documentation standards. But it also means more transparency for investors and a better reflection of the economic reality of the business combinations. We have two channels, RR Corporates and RR Legal Talks. Please do subscribe and hit the bell icon so that you will not miss any of our latest updates. Thank you.